So we are currently witnessing the market break into new all-time highs, and this is exactly what we predicted was likely to take place exclusively for those within the Push and Profit private group. Now, in this video, I want to go ahead and talk about what we're likely to see coming forward with the broader markets, and also talk about what are our predictions in regards to what the Federal Reserve is likely to do. But in order to go ahead and talk about that, I want to go ahead and rewind a bit and kind of just highlight some of these arrows and what we've done exclusively within the Push and Profit private group, which for those that don't know, that's essentially a group where every single day the markets are open. I provide a daily briefing of what's going on in the economy, what's going on in the markets, and what are some trade ideas that I like. Now, we've been pretty much buying the dips on all of these inflationary reports, such as the CPI, in the last few months. Now, of course, we'll go ahead and talk about why we saw today's CPI go up, and pretty much boost the markets up. But I want to talk about how the market was misinterpreting the previous inflationary reports for the last few months, and we've been seeing this as buying opportunities. In fact, back in January and February, we saw these as dip buying opportunities because there were some anomalies within the CPI report, which typically happens in the first couple of months of the year. We won't delve too far into what exactly those anomalies are, but we'll go ahead and kind of fast forward to March, and then of course in April, where we saw the report definitely bring the markets further down. Now, one of the things I've been stating is that the data that a lot of individuals have been looking at or worried about has been lagging data, and when you look at higher frequency data, it was actually painting a much different picture. For example, one of the two pieces contributing to inflation has been shelter, and then, of course, auto premiums or auto insurance premiums. And one of the things we've stated is that when you take a look at rents and rents equivalents from a higher frequency data point, and also taking a look at auto insurances, we're seeing that it was likely to start to kind of slow down. And so we, again, bought the dips on the last few inflationary reports. And while all the market pundits were saying, oh man, the market toppled over, things are looking bad, inflation is sticky, well, we saw this as a great buying opportunity, and that's why in our long-term portfolios, we are absolutely just dominating and by far exceeding the market returns so far for the year. And so let's go ahead and talk about a couple of things. So why did I know, or how did I know, that we were likely to see one of the issues such as auto insurance premiums fall down? Well, let's go ahead and highlight that. So one of the data points I pointed out before within the Push and Profit private group exclusively was the Mayhem Used Vehicle Value Index, which is by Cox Automotive. And we started seeing that used vehicles ended up falling downwards consecutively for the last few months. And this, kind of created the idea that, hey, look, as long as car prices are falling down, we're likely to see insurance premiums fall down as well. And to kind of give everyone a backstory of what ended up happening, how did insurance premiums skyrocket? Well, we had to kind of go back to the pandemic, back in 2020, when there was a low supply of vehicles, and that pretty much caused vehicles to eventually in 2021 go to these insane high prices. I mean, everyone knows that used vehicles during the pandemic were extremely overpriced because of the lack of supply. I mean, we got to these high extreme levels, and for a while we did not see auto insurance premiums catch up. They were lagging behind. But guess what? Then eventually we started seeing auto insurance premiums start to go upwards, and the reality or the reason for that is because, of course, the more expensive a vehicle is, well, the more expensive the insurance is going to be. If you get into a collision, well, now the maintenance and repairs to go ahead and fix that vehicle is a lot more expensive. There's low supply. It's going to be harder to get that new door frame or whatever the case may be. However, we ended up seeing, as I stated within the Push and Profit private group, how used vehicles and even new vehicles, right? I even showed data on how new vehicles and rental vehicles are all falling down. So pretty much all vehicle prices have been falling downwards, and that was likely to cause the auto insurance premiums to go down, and that's exactly what we saw. In fact, if we take a look, for example, today we had another inflationary gauge, and this was a positive one, as the U.S. inflation ebbs for the first time in 6 months in relief for the feds. Now, we were pretty much already aware that this was going to be a positive inflationary report. We talked about it the night before, literally within the Push Your Profit private group. And one interesting note here from Wells Fargo, their economists, they highlighted how motor vehicle insurance and motor vehicle maintenance contributed to the slowdown in core CPI. Wow, it wasn't that tough to find out that, of course, if used vehicle prices were falling downwards, well, eventually the lagging insurance for these vehicles were likely to come down as well. But a lot of the market pundits are late to the party. They're way behind. And one of the things I shared within the Push and Profit private group this morning is how all the market pundits and experts are going to be shifting from sticky to inflation is cooling now. Watch, you guys are going to be seeing this just all day, and how all these managers are going to be scrambling to update stakeholders on why their opinion is changing again, and markets are responding. And again, we talked about how this was likely to take place. We said auto insurance fell to 1.8% month over month from a previous 2.6%. Zero surprise from us, as we've delved into this topic many times. And so again, this is what's contributing the markets to kind of push upwards. And so now that we got everyone kind of caught up to what we've been talking about within the Push and Profit private group, I want to go ahead and talk about what we're likely to see moving forward. So let's actually parse through SPX, which is the same thing as the S&P 500 index. And one of the things I recently stated is that, you know, of course, once we held above this area of 5,200, well, that was going to be the kind of area where we were going to start breaking out. And I said we have to wait until that CPI report comes out, the one for that we just got, and that was going to help push us up to the new highs. But I also stated that we were likely to consolidate for just a few days, for just, you know, a brief time, where we're going to kind of consolidate around these areas where we were back in March 28th, when we recently hit those new highs. And that most likely, as we hop into the summer, my prediction is that we're going to go into the 5,400 area for the S&P 500. And I know some individuals are going to say, no, that's crazy. We're paying these high premiums for a lot of these multiples. Yes, for some of these, especially I believe Tesla right now is a bit overpriced from a fundamental perspective. But a lot of these companies, their earnings that we recently got have pretty much helped shape us kind of get out of these lows after we had that bad inflationary reading. And because of those forward guidances and the forward estimations from pretty much earnings per share, we're likely to again see the markets push upwards, as now we could kind of justify the high premiums and actually see the markets extend a bit further. But again, that's going to be with a bit of consolidation before we actually go into the summer of 5,400. Now, that's the prediction that I shared exclusively within the Push and Profit private group, but I figured I'll just share it here publicly on YouTube. I don't mind sparing kind of one of the predictions that we talked about within the private group, as we've been killing it with a lot of names. I mean, we killed it with Nvidia this year as a trade idea. Recently, we're killing it with actually, you know what? Let's actually not talk about all the. I want to keep some of the trade ideas exclusive, so let's not go through the list here. But if you are interested in joining the Push and Profit private group, make sure to click the first link in the description below, as there is a major discount today for CPI Day. It's going to be expiring in 24 hours to join. So make sure to take advantage of the discount so you guys could see for yourself if you're interested in the private group. And again, you could leave at any time if you don't find any value in it. But I do recommend you guys give it a try, because we have been pretty much nailing it on point. But with that said, I want to go ahead and toggle over to something else over here, which is the pretty much calendar for the Federal Reserve. We are on federalreserve.gov, and here you can see the calendar. And so here are the meeting dates. Now, June is going to be a very important meeting date, because again, you see this asterisk right over here. This simply is meetings associated with the summary of economic projections. Now, a lot of individuals, they kind of skim over this, or some individuals don't know what this is, especially some of the furus that you see here on YouTube or X. They're like, what is that, right? Now, the SEP is going to be a huge data point that we're going to want to look into, especially after these recent inflationary gauges, because then we're going to get a dot plot of where the members of the FOMC are expecting rate cuts to happen. And my prediction is that we're likely to see that take place around July or September. Now, of course, the idea is that we're likely to start rallying into the summer And then, of course, and that's kind of front running the idea that, look, we're going to have those rate cuts, right? We've heard Jerome Powell state that rate hikes are unlikely at this point. So we're kind of, that's far been behind us. I mentioned that months ago that we were not likely to see any further rate cuts. I mean, I think we ended saying that back in maybe November 2023 that we were, or was it December? One of those times back in 2023, we said, look, inflation is done for. We just have to give it some time. And eventually, we're going to see these restrictive rates in the federal funds rates start to come into play, and that's going to help kind of bring inflationary or the inflationary pressures down, and we could begin to have those rate cuts. And of course, the reason why rate cuts are bullish for anyone that forgets is because it makes cheap money happen again, right? It makes financing much affordable for consumers to go ahead and purchase, and of course, for all these companies, it makes borrowing a lot cheaper. And so this is going to be the start of a great time within the markets. We're already seeing a bunch of financial institutions and analysts adjust their projections for the end of the year. Of course, now they're adjusting their projections while we've been pretty much on point with what our ideas have been since the beginning of the year. But again, hopefully you guys found some value. I wanted to just catch everyone up to speed as why we're seeing the markets go up and where we're likely to see the markets by the summer. With that said, I'm going to go ahead and end this video right over here. But before you guys go, make sure to check out this next video right over here. Subscribe to the channel as well. And I'll see you guys on that next video. Take care, guys.